All right, here we go. Welcome to interest rates and federal funds rate. This is going to be a little bit of a, I wouldn't say lengthy topic. I would definitely say in-depth topic. That is why it is within the advanced recordings. Understanding interest rates usually takes most people quite a little bit of studying. It's not something you just understand right away. There's a lot that goes into it. Every single month or 2 months, whatever that range may be, the federal funds rate occurs, and the government sets a interest rate target. We set the overnight rate at which banks borrow money from the federal government. So this topic is a little lengthy. Strap in. Definitely take notes. I'm excited to be here with you guys. Grateful to be here wherever you are watching this video. I hope you are enjoying all the content. I hope you are making money, and I hope that you are continuing to grow. Excuse me. Continuing to grow every single day. So let's waste no time. Got to get into it. Try to keep this under 20 minutes. Let's try to go for under 20 minutes on this one. So let's do it. So what are interest rates? Interest rates are a fundamental concept in economics and finance. They represent the cost of borrowing money or the return on investment for lending money. Interest rates play a crucial role in shaping economic behavior and financial markets. Okay, do not get too into the 3 bullet points here. I do just want you to know the type of interest rates. With the type of trading we do, you do not have to know what these interest rates are. But when it comes to purchasing houses, when it comes to taking loans, when it comes for big businesses that take a massive loan out on a bank, especially if you buy government bonds and if you buy treasuries and you're getting paid out a certain interest rate, you have to know what your nominal, real, and effective interest rate is. But for right now, just don't worry about it too much. But the nominal interest rate is the stated interest rate on a loan without considering inflation. So like most of the time, like if you buy a car, you'll get a nominal interest rate, right? You're going to get just a base sticker interest rate. It's not really including the inflation that comes over the next year, year to 5 years. Your real interest rate is adjusted for inflation and reflects the true purchasing power of your money. You subtract the inflation rate with the nominal interest rate to get that. And then the effective interest rate takes into account compounding. So it is the interest that's calculated on both the initial principal and any accumulated interest from previous periods. But like I said, don't worry too much about those. Really, what we're mainly focusing on is the one interest rate that is set by the Federal Reserve that determines how expensive it is to borrow money as a business, as a person, as a lender, as a borrower. So factors that influence interest rates, the central bank policy. So the Federal Reserve is the federal, the federal bank that overlooks the spending and income of the U.S. government and how we allocate our money. So it plays a significant role in setting short-term interest rates through its monetary policy. The central bank adjusts interest rates to control inflation and stimulate or slow down economic growth. Inflation expectations. Higher expected inflation rates tend to result in higher nominal interest rates to compensate lenders for the declining purchasing power of future payments. If we, as investors, think that inflation expectations are going to be higher, if inflation rates are going to be higher, this results in a higher nominal interest rate, right? Which helps inflation go down. So that makes sense. Supply and demand for credit. The supply and demand for loans in the financial markets influence interest rates. When demand for loans is high, interest rates tend to rise. When demand for loans is low, interest rates go down. So the reason we have high inflation is because too many people are taking out loans to buy houses, to buy cars, to start businesses, to travel, all, credit card debt. That's same shit, right? You're paying interest on that. So any amount of borrowing makes interest rates rise, okay? When nobody's getting a loan and when not a lot of people are making a whole lot of money or buying houses or cars or all that stuff, interest rates are lower. So it's less expensive to get a loan. You're not paying back as much money when you take out a loan. Economic conditions, the overall health of the economy, including factors like gross domestic product growth, unemployment, consumer confidence, other things can impact interest rates. In a strong economy, interest rates may be higher to prevent overheating, while in a weak economy, rates are lower to stimulate borrowing and investment. By the way, this is all going to tie in to Forex Factory and the DXY. Okay, this is going to tie into the DXY and the FOMC federal funds rate. Okay, global economic conditions. So exchange rates, global economic events like war, trade, all of the stuff, tariffs, all that stuff that impacts capital inflows to the dollar index. What do we use interest rates for? For borrowing. Okay, individuals, people, everyday people, borrow money from banks and financial institutions to finance activities, homes, business operations, expanding operations. Maybe you just want to make money on interest. Investing, savers and investors earn interest on their savings and investments, which can include bank accounts, bonds, stocks. Fidelity pays 5% on just keeping your money with them. So there's so many ways to earn interest on your money. Monetary policy. So central banks use interest rates as a tool to implement monetary policy. Lowering rates can stimulate economic activity by encouraging borrowing and spending, while raising rates can help control inflation by reducing spending. Guys, this should really all make sense. Like, it's pretty simple. If you want people to spend money, you got to just lower rates, right? And if you don't want people spending money, you just raise rates. Pretty simple. Well, in that context, it's simple. The yield curve is a graphical representation of interest rates, and bonds and different maturities of bonds. You have 10-year, 5-year, 3-year, 20-year, all types of different bonds, right? A normal yield curve slopes upward with long-term interest rates higher than short-term rates. The inverted yield curves, where short-term rates are higher than long-term rates, can signal economic recession concerns, which we saw a yield curve, right? We saw an inverted yield curve kind of a little bit into leading into this year, kind of last year a little bit. Impact on personal finances. You have, interest rates affect individuals like mortgages, car loans, credit card debt. Credit card debt's a big one. We got I'm sure we got over 2 trillion in credit card debt alone as a nation, as a country, which is a lot. Returns on savings and investments. So understanding how interest rates affect our everyday lives is crucial to making informed financial decisions. Now, how do we apply this to trading? Why do interest rates have an effect on the economy or the markets? So when the Federal Reserve comes out and has a meeting and they're determining the interest rate, investors are always looking to see if the economy is doing good, if the economy is too hot, if the economy is cold, and we need to lower interest rates and boost spending. And so when the meeting happens, the FOMC comes out and says what the interest rate is and what the future projections look like. So it is set and controlled by the Federal Reserve, which is the central bank of the US. And the federal funds rate plays a crucial role in influencing the overall interest rates in the economy and broader economic conditions. Okay. The federal funds rate is the interest rate at which depository institutions lend reserve balances to other depository institutions overnight. These reserve balances are held by banks at the Federal Reserve to meet their reserve requirements. If you go to Bank of America and you apply for a $10,000 loan, where do you think Bank of America gets the $10,000? The Federal Reserve. Oh, now it's starting to make sense, right? Bank of America doesn't got 10 grand, bro. They don't have 10 grand. And I know that may sound really whack because they're a bank. Of course, they must have 10 grand. Every single bank that operates in the US is funded and supported by the Federal Reserve. Make sense? If that bank does not utilize their money correctly with their clients, they will go bankrupt and the Federal Reserve will have to bail them out. Okay, that is why you saw the bank failures happening, SFB Bank, a couple other ones within the last 2 years. And that is what happens, okay, is when banks don't properly control their reserve balances. Okay. The federal funds rate is one of the most influential interest rates in the US economy. It affects the interest rates that banks charge each other for short-term loans, and these rates in turn influence the interest rates offered to consumers and businesses for various financial products, savings accounts, loans, mortgages. The Federal Reserve uses the federal funds rate as a primary tool for implementing monetary policy. By adjusting this rate, the Fed can influence the overall level of economic activity. When the Fed wants to stimulate economic growth and reduce borrowing costs, it lowers the federal funds rate. This encourages banks to lend more money at lower interest rates, stimulating borrowing and spending by consumers and businesses. Conversely, when the Fed is concerned about inflation, hint, hint, right now, or within the last literally 6 months, depends when you're watching this, but an overheating economy, it may raise the federal funds rate. And this makes borrowing more expensive and can help cool down economic growth. If interest rates are high and I need a new car, I might wait to buy a new car until interest rates lower. Make sense? Pretty simply put. So you have open market operations, okay? The Federal Reserve conducts open market operations to control the federal funds rate. When the Fed buys government securities, like treasury bills, from banks, it injects money into the banking system, putting downward pressure on the federal funds rate. Conversely, when it sells its securities to banks, it drains money from the system, pushing the rate higher. Guys, money's fake. Like when we took it off the gold standard and we introduced this system, it's literally just a piece of paper with nothing backing it, saying that, oh, we're going to buy X amount of treasury bills or sell X amount of bills, and then you're going to pay us back X amount over time. It's really just based on debt and printing more money to continue to pay more debt. It literally, that's how it is. So we have a target range, okay? The federal funds range. This range is a desired level at which the Fed wants the rate to trade at. The actual rate may fluctuate due to market forces, but the Fed uses it to keep within a target range. Usually the target range of the federal funds rate is like 1.5%, 1%, 2%, which is not very high. Sometimes even just 0.50%, 0 if possible. And let's see here. Other banks, other like countries, like, you know, Bank of England, Japanese Bank, Bank of Japan. Excuse me, my allergies have been unbelievable. A lot of pollen in the air. Excuse me. All right. Changes in the federal funds rate have a cascading effect on other interest rates throughout the economy. For example, when the Fed lowers the federal funds rate, it often leads to lower interest rates on mortgages, auto loans, and various types of consumer and business loans. Excuse me. Conversely, when the Fed raises the rate, borrowing costs tend to rise. Oh my gosh. All right. Whew. So let's look. Okay. Market participants, which includes us, we closely monitor the federal funds rate as an indicator of the Fed's stance on monetary policy. A change in the rate can signal the Fed's assessment of the economy and its intentions regarding future policy actions. So let's take a look here. Okay. Ugh. This is the federal funds rate, right? Notice how the actual and the forecasted is 5.5%, right? It measures the interest rate at which depository institutions lend balances held at the Federal Reserve to other depository institutions overnight. The rate decision is usually priced into the market, so it tends to be overshadowed by FOMC statement, which is focused on the future. Short-term interest rates are the paramount factor in currency valuation. If your dollar is paying out 5.5% interest, you're going to hold US dollars. You're going to buy treasury bonds. Okay. Literally, like every single billionaire investor is going to have treasury bonds when the dollar is paying out 5.5%. If you're a bank, right? If you're a big bank, you want to lend out more money at a higher interest rate because you get paid back more money, right? If you're a saver, if you're an investor, right? If you had 100 grand, would you prefer 2% interest on your return or 5.5% interest? So, tit for tat, right? FOMC members vote on where to set the target rate, and the individual votes are published in the FOMC statement. Okay, so let's get out of that. Let's go to this. A little bit of that, a little bit of this. Okay. The recording of this video is Tuesday, January 30th. Tomorrow, we literally have the federal funds rate. They are keeping it the same. Look how long. I made that slideshow in September or November, something like that. September, October, I made that slide, and the rate has stayed the same. It's literally stayed 5.5%. Okay. So we are trying to continue to get inflation down to a 2% target level. Let's go to the DXY. Okay. To the DXY. So here we are in boom, October. Okay. October 2023, right? We are like the federal funds rate was still 5.5%. The market is trying to price in rate cuts. I don't know if that makes sense. It should. You're in the advanced section. The Federal Reserve is trying to get inflation down to 2% target. The market is pricing in rate cuts. Okay, we should be able to see rate cuts happen and the dollar index go lower. What happens if we don't see rate cuts occur? What happens if the FOMC can't start cutting rates as early as they anticipated? We will see the dollar go back up higher to this 105, 106, 107 level. And that is how we utilize interest rates, guys. That is how we utilize the FOMC meeting, how we analyze the market using FOMC, using federal funds, understanding where we are in the economy. Look right here, guys. The interest rate was literally 0.25%, literally not even 1% back in January 2022. Okay. Where was the dollar index? Okay. In 2022. Literally the beginning of January, the dollar index was at 95. Okay. Right when they hiked interest rates on March 16th. Okay. March 16th was right here. Boom. Look how dramatic the dollar index went higher. I mean, come on, bro. Are you serious? Like that is all buying. So many people were buying dollars. You know what I mean? You want to know something even crazier though? Is that the people who knew we were going to hike interest rates before March were already in the market here. Like they knew before it, like they knew it was old news when it reached us. I like understand that. It was old news when it reached us. Okay. But there was still a drastic move to the upside from March, right? When they first started hiking rates, right? Raising the federal funds rate. And you can see how they increased it dramatically. And here we are at 5.5% called quantitative easing. I'm sorry, quantitative tightening. We are in quantitative tightening, which means that we are holding interest rates until we reach a specific target on inflation. Okay. So notice the peak of the DXY, September 2022. Why? Why? Because investors are trying to price in the end of rate cuts. The markets are trying to price in all this cutting that we want to see. But in July of 2023, where is it? Right in here, right? June, July, right here. Investors thought, oh, when it reaches 5%, we're going to start cutting. No, that's not what happened. We had to continue to raise interest rates. So for another 3 or 4 months, right? The rates stayed higher and the DXY went higher. Okay. So here we are again. Right. Here we are again. October 23rd, right? Boom. October 23rd, after the same interest rate that stayed the same. Investors are trying to then again price in rate cuts. So tomorrow is a big day. Tomorrow's a really big day. If the FOMC comes out and states that they're not ready to start cutting rates, we're most likely going to see the dollar index continue higher. If they say they're going to go ahead and start cutting rates in the future, we're going to see the DXY melt. Melt, 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 and melt. So, guys, that's going to go ahead and end it for this video. I hope you enjoyed. Please reach out if you have any questions. Understanding interest rates is massive to your fundamental analysis. I hope you guys enjoyed. I will see you all on the next one. Peace.